Welcome to this Destiny video blog where Margaret Lomas shares her expertise on many aspects of property investing. Today, we hope you enjoy listening to Margaret talking about buying old or new property.
It's probably one of the original property investing debates. Should you buy an established property or a new one? And as in most debates, there's no single answer. In fact, the answer is it depends. Ask any developer and they'll tell you that you should only buy new. A new property comes with significant depreciation benefits, meaning that you're more likely to see a positive cash flow, a situation where the shortfall between income and expenses on a property is removed by tax benefits which exceed that shortfall. Of course, we should ignore the fact that a developer thinks new is best, and also that depending on whom you buy from, very often developer profit hikes your buy-in price above that which you should pay for a similar property which is a few years old. The point is, you need to consider the entire argument before you decide what to buy. New properties do carry depreciation benefits. However, if you've ever fully read a depreciation report, you might have noticed that often the depreciation available in years 2 and 3 is higher than it was in year 1. Why is this? Simply, once items fall into a low value pool, as they tend to do after a few years, you get to claim larger chunks of them in one go. I've also found that often a property which is 2 or 3 years old is better value than the new one. It's like that brand new car which loses 15% of its value as you're driving it out of the showroom. With new property, the premium you pay is quickly absorbed and value's lost almost immediately. The property which is a few years old also has been a little run in with any major issues most likely identified and fixed already. Remember too that the value of a property is determined by the recent sales in the area. A new property is harder to value because there's little to compare it to. I've lost count of the number of times that I've seen investors buy property in massive new developments only to find that a year later the property is worth $40,000 to $60,000 less. This loss is likely due to a combination of factors. The developer profit made it more expensive in the first place. The size of the development created a supply issue for which there wasn't enough demand, and the market was now undergoing its first real test. Resales were happening and the true value was finally being realised. Investors really shouldn't be starting their search for property with a decision to go out and find only a new property, as this suggests that they're considering only the cash flow. I've seen many beautiful new properties full of tax benefits being sold by middlemen on big commissions to investors who simply want to see a positive cash flow, and those investors didn't bother to analyse the real viability of that underlying asset in investment terms. The result is a positive cash flow property which fails to thrive and a disappointed investor who realises that you can't retire on cash flow alone. All investors should first determine where the best area is to buy. Then they should find out what type of property is in most demand there. Once these factors are established, it'll be much easier to know whether to settle for an established property or go for new.
If you think you've learned something from this video and would like to become a better investor, why not give us a call? For more than 2 decades, Margaret Lomas and her company, Destiny, have been helping investors to build substantial property portfolios using safe and successful strategies. Destiny is different because we don't sell property. We are truly your advocates for property investing success. To find out more, call us on 1300 693 378 or visit our website destiny.com.au.